This is eSec Lending Insights. Let's get over to our episode. First of all, how are you all doing?
I think we're good. We're all good, thank you. How are you doing, Brooke?
Oh, good. Well, thank you for asking.
Yes.
I'm happy to be podcasting with the three of you. So I've been trying to do this for a little bit. I appreciate that even though it's pushing towards the end of the year and arguably people are out and it's busy and it's towards the end of the year. So I've been pushing a snowball up the hill unsuccessfully, trying to get this scheduled, I guess.
Here we are. Let's do
Yeah.
it.
All
Let's
right.
do it.
Okay. Year end is upon us, friends. This will officially be released in the new year. I know that we're a few days before year end in 2025, heading into 2026. How do we feel about that?
How do we
I
feel
guess
about the end of the year or year end itself? Year end itself, I feel pretty good about. Another
Okay.
year, this year went quick.
How do you feel about the end of the year then? Is that a deeper answer, a deeper
It,
question, deeper answer?
it's probably for a different podcast. Yes. I'll need a couch to lay down on too.
Okay. It is sort of a big year to close out on. And I know that I've said this on many podcasts at this point, but it's a quarter of a century past in this century. And it's also a quarter of a century in our own company history, my personal history in our business in securities finance. It feels like a big year to come and go.
That's a humble brag. That's Brooke's way of saying I've been here for 25 years.
Well, it wasn't me, but
Quasi-founder
that's
of
not
the
a
company.
that
Yes. You,
hold on. I did say that. That was what I actually said. It wasn't my way of saying it. Yes, I did say that.
yes, you did. Well,
All right.
congratulations on the 25 years of BG at eSec.
So, Jim, you're feeling good about year end. Mike, how are you feeling?
I'm feeling good. It was a busy year. I think a lot of technical factors that we don't have to dive deeply into. Obviously, it was the first year of a new administration, so that always adds a bit of maybe some extra volatility and some whirlwind. I kind of agree with Jim. I think the year flew by really quickly, but for that reason, I think a lot of people put year-end emphasis around the turn really maybe earlier on. This time around, you started seeing leading indicators, for lack of a better word, that reporting dates, just dates that are balance sheet and dealer sensitive, could cause some outflows, especially in our sec lending kind of non-netted 102 haircut type world. So for that reason, I think a lot of people got out ahead of it and really prepared for this Wednesday. So coming into this week, I feel pretty happy about where the books are. I think that's really just a function of it hasn't been weeks of work done to get to this point. It's been more months of work. I think borrowers are a little bit more transparent and upfront leading into it that, hey, sheet's going to be tight. Let's go for the conservative number here for where our allocations will be. That's not always the best thing to hear, but it does help you prepare. You rather that than get the tap on the shoulder come Tuesday afternoon that you have to go down some percentage of your book, right? So for that reason, I think there's not as much at risk this time around. I think it should be pretty smooth sailing. Knock on wood, obviously.
No, that's good. I feel like that's a different reality than you predicted, though, I don't know, a month or two ago. Speaking of predictions, is it just the good planning and the good communication that's brought us to this point where you think it will function smoothly, or overall were things a little less crazy and less volatile than maybe you had anticipated?
A little bit of both. I think the planning allowed for borrowers to get their allocations from the agent lending side as well. So we've had a few guys that maybe didn't take their balance sheet capacity, and then that allowed the borrowers to intermediate it to other people who needed it. So we had a few of those conversations. I do think the recent Fed decision where they mentioned repo markets at the presser, the end of QT, as well as the buying of bills, their reserve management program, were some technical factors that maybe we didn't know 2 months ago. Some people predicted that that might happen, but we're already seeing weekly purchases, weekly adds to really reserving cash to the market. That's maybe helped our markets move a little smoothly. Looking at markets on Wednesday, we're expecting firmness. It's going to be higher than where repo markets are trading now, but much lower than where a month or two forward markets would have predicted. So I would say kind of combination of all.
All right. And McNeil, how are you feeling? I know Jim already said he was feeling good, but I'm not sure that that really matters. I think it's more a question of how you're feeling around the equities and the corporates.
Thanks for that. Appreciate you putting the emphasis on my feelings and thoughts. Yeah, I think
You're
Mike.
also much easier to work with, let's be clear. So it's easier to focus on your feelings and thoughts.
I can't
I hope my
deny any
wife
of that.
listens to this episode.
Yeah, that's true.
All right, so I think Mike made a great point for this pod. I was thinking about it a bit too. So I think part of year end traded this whole year. So let me explain what I mean there. So there's demand, say, for different funding wrappers in secured funding from the street, from GSIBs, or for different non-cash structures that provide sheet relief and things like that, right? And we know there is an idea of maybe how a certain counterparty wants their book to look on year end. And then we also know our clients have an idea of exactly how their book wants to look on year end. So I think both sides of the trade now appreciate it's impossible to get there in a very short amount of time. It can't be December 1st. And you're like, hey, I need to move all these things around and get my book to look this way and have X dollars of secured funding or have this much of 3-month funding. So we saw opportunities, and I'll call them year-end trades, but whether it's an LCR trade or a balance sheet trade or things that our clients wanted to fund that were advantageous to counterparties as well. So we started putting those trades on in Q1, and then they kind of ramped up throughout the year. So really, I'm very pleased with how, say, this year end has gone because we took advantage of it the full year. And then I think we've really kind of insulated some of our liquidity very well. And looking at the data for this month, securities lending volumes are at some pretty high numbers right now, especially on the back of that triple witch. I'm looking forward to getting through this week. And I think we're in a really healthy spot because so much of the work was done in the first 3 quarters, as opposed to last year, where I think some people were a bit surprised by how intense that year-end trade was.
Okay, so the message there is if you're interested in playing in sort of the year-end trade opportunities, you really need to be around the full year playing the game.
Yeah, well, there's opportunities that present themselves this quarter too, but if you're open to having those conversations with counterparties and clients and looking for places where maybe there's a product expansion required or just more focus on it on the trading desk, hey, this is something we really should be working on with this counterparty. So anytime we have a conversation with the client, I'm going to mention this trade. When you get to a spot where you can really articulate it well and everyone appreciates both sides of it, those are trades you want to start working on well in advance. I think that not just eSec, I think the whole street was more mindful of that. But in particular, we really put a big emphasis on it, and our clients did a great job of finding those value pockets.
All right. Well, you made reference to some of the data points. You said improving, right? After the triple witch?
Yeah, we saw a lot of borrows on the back of that OpEx. So we saw some pretty tremendous flow. It was a big settlement day. It was definitely bumpy, always some big up days. We did see outflows a couple of days as well, but overall, I think there's been more liquidity in the market this year on the stock loan borrow side than there probably was at this point last year. A lot of it seems to have been on the back of that triple witch settlement.
This time last year, you would have talked about eagerly anticipating the turn and wanting to get into January and new trades, therefore, being viable and balances able to increase again because balance sheets are maybe less sensitive. Do you feel the same way right now heading into next year? Do you feel like that a lot of opportunity is going to open back up again once we get into January? Or do you think that maybe where we are now is pretty stable and there's always room for growth? But do you think it's going to be a notable change where balance and opportunity is today versus where we might find ourselves a month from now?
I think it's a good question, Brooke. In terms of balance growth, another spam risk call. Do you guys get those? I get them all the time.
You
What
can
happened to the
now
no
have
call list?
you don't have a fancy phone. You have a phone that a smaller portion of the population utilizes.
Correct.
Yeah, never mind. I
all
was
right.
going to tell you about how there's new functionality where you can have your calls screened.
Fine, I'll get an Apple. I'm sick of being the green bubble guy, so it's time
Yeah,
to move on.
you're super irrelevant.
I know, and I ruin almost every group chat.
It's so
And
true.
and I think that I
You
have
got to
less
pick your
friends.
friends wisely,
I have less
folks.
friends because of my phone now.
And that's before you start trolling them.
That's right.
Speaking of a group chat, there's someone in the market, and if that person is listening, he'll know exactly who he is. But there's a group chat, just myself and this one other individual and Jim. And more often than not, when the activity starts, it's as though he doesn't exist in the chat. He's on the chat. We talk about him. We engage as though he's paying attention, but it's crickets. He's silent. And so I make note of this last week and how Jim's on this chat, but yet he's never there. And I scroll back up and find, has there ever been any sign of life, Jim, on this chat? And I scroll back up by months and almost a whole year, and I find a photo with Jim strategically using one of his fingers, not an index or a pinky or a ring finger, letting us know how he felt about the group chat.
I participate.
Yeah,
you
yeah,
just don't like
you
my
were a
participation.
participant in your own way. Anyway,
Ah,
back to you, Jim. 2026.
yeah, that's on my list of things to be better at in 2026. Respond more frequently to Brooks' group text. 2026. So I do think balances will grow. Pretty specific though for segments of the agent lending world. And so I'll explain that. I think there's a lot of changes on the horizon. This isn't predictions. Most people think this, but there'll be some banking relief for SLR measures that banks have to abide by. There's some talk of the SEC changing 15C3-3, which is that customer pledge requirements broadening to liquid equities. So that plus continuation of Mark talked about different wrappers, and I think most in the market today now have a version of asset seg, collateral, whatever you want to call those RWA mitigants, where you set aside collateral and have lien language over it for the borrowers, which gets RWA down. The combination of those three things is going to lead to big changes. And I think one of those changes will result in better balances for those who participate in asset seg or those who can accommodate borrowers in the easy space. And so I think borrowers will likely do less business, and I don't have stats, so we want to call this a prediction. We can look back at the stats, but I think borrowers are more likely to shift easy balances to traditional lenders and away from the borrow to borrow market. So you also have the potential for CCPs, whether it's DTCC or OCC, playing a larger part in the market in 2026. So maybe that's four different potential changes that could happen, and you may get all four, you may get a combination of it.
Do you think any of that, so some of that might be a shifting of where supply and demand meets to other venues or to other lender participants, those that can offer more efficient capital solutions? Do you think that some of those, and maybe specifically asking about the equity collateral or 15C3 potential that goes through, do you think any of that actually just increases overall balance and utilization in the market? Or do you think it's, again, a shifting of collateral preference and a reoptimization of trades?
Yeah, it's mostly shifting, I think, Brooke, but it could change borrower behavior in terms of internalizing. Maybe it becomes less in a combination with SLR relief such that they have more balance sheets, so it's not as important to get things off sheet. So it won't be as advantageous relative to their alternatives to borrow internally versus borrowing from stable supply. But I really don't know. With those combinations, we could see if 15C3 happens, we could see cash balances in the states go way down or
Mm,
not, right? It could just be a shift of other balances and cash balances remain. We could see cash balances get more expensive in the US and
mhm.
go from at the marginal where it's kind of plus 10 and change is kind of what it costs. Maybe it goes to plus 15, plus 20, plus 25, closer to kind of the repo market and raising cash through repo and non-purpose. So I don't really know. I don't know what the combination, but change is coming. And I think the net of it should be that GSIBs end up doing more business with large traditional lenders through agent lenders or principals.
Okay.
So
And away from the broker to broker community,
I think
potentially.
so. Yeah, I think there was good broker to broker growth in terms of balances this year. I think that was dictated by regulatory requirements and balance sheet. And so if there is relief there, you may see a shift to more stable balances or balances that the broker would perceive as can be leveraged into more value, be it more
Hmm.
specials, better allocation of M&A, different things that they look at when they decide to do business with a particular agent lender or a particular beneficial owner.
Okay.
So
Mike Brooks, what do you think is going to happen after the turn?
I think utilization will increase in Q1 compared to Q4. I think that just tends to be the case as we tend to see the most outflows in Q4. I do think borrowers are going to be more and more sensitive to the type of business they're doing. I don't think you'll have as many guys willing to just lend their sheet to agent lenders with the haircuts and just bid in a bunch of collateral without looking at kind of ancillary business. So I think we see this a lot on the equity side, right? We call it the fully funded trader getting cash back. We're starting to see that on our side of the market as well. If you give X amount in balance sheet, they're looking for some amount of money back. And it doesn't have to be repo in the same product. It can be a fixed income repo, equity repo. It can be anything that gets them cash back that helps them satisfy certain funding needs. It could also be you can buy in the unsecured space in their name or other issuance that they are looking to sell. The non-cash business helps as well. So really anything that just aids to the suite of the relationship, I think we'll be looking to do a lot more package trades. And I think borrowers will be looking to tie a lot more of that together. I think that fits our strategy pretty well, though, because for us, for those that we have a nice wrapper with, I think that tends to be the sticky business. We find the business where we have just say 500 to a yard of just treasuries on open, and that's all the business we do. That tends to be a little hotter money than maybe some of the stuff that we have packaged. So when we're looking at dates this week and year end and we see where our sensitivities are to possible outflows, it tends to be the business where we're strictly just lending collateral versus cash. And that's really all we do as a program. So I do think borrowers and maybe agent lenders as well will look to better package this stuff up going forward and maybe make it look more product than just a bunch of one-off trades.
Okay. So when my family gets together around the holidays and we sit around and have a big meal, we don't really play games because we tend to be hyper competitive and accuse each other of rigging the system oftentimes. So that doesn't always go well. But we sort of play, I guess, I don't know, go around the table and everyone takes a turn sort of game. So things like, what do you want to do more of next year? What do you want to do less of next year? What are you most excited about next year? What are you least excited about for next year? The good and the bad, or the excitement and the less of. But why don't we go around, maybe give me one or two things that you think you'll either be doing more of, and it can be consistent with probably some of the things you just mentioned, or that you're excited for in the market, and maybe on the flip side, one thing at least that you'll inevitably end up doing less of next year or hope to do less of as a result.
Want me to start?
Yeah. Why don't you start,
So
Jim?
I would like the desk to do more specials trading next year, and I think it's in scope. Since the meme stock days, which predates, if my memory's correct, predates COVID, right? Because it was
Yeah, it
right
did.
before COVID.
Yeah.
Behavior changed through those meme stocks, and we didn't see hedge funds and long short types piling into thematic trades. We just saw less deep demand for specials. But this last year, it's changed quite a bit. These IPOs that have come for us, and we've talked about this on other podcasts, most of our clients are indexers. And so these are non-index names, or they are when they come to the market. So we trade less of it, but those names will become mature and be added to indices. And there probably will still be those themes. It's changed. The shorts are much, much deeper today. And the tenor of rates are stickier. So if you get into the 20, 30, 40% fee, they tend to stick there longer and not just be a 2 or 3 day trade. Well, my hope is that our clients own more of that and we continue to see IPOs come, companies flourish in the face of that short interest and still get added to indices and do more of that. I want to do less GC trading. We are working hard
Do we
to
need McNeil to say he wants to do more of it then?
he's going to back me up on this, but we're getting close to automating all the pieces of our book that we want automated, which is
So
just
it's
about
not that
everything.
you want our business overall to do less of it. You want to touch it less
Yeah,
often.
I
Okay.
think so. Yeah,
Okay. All right. Well,
in the GC space.
yeah, that supports the shift in technology and more trade solutions. So makes sense. Okay.
Yep,
All right.
that's it for me.
Mike, you look eager to go next.
Yeah, I was more eager at Bloomberg I got, but I can go here. I'd like to do more, and kind of piggyback what I said, more structured trade, more non-cash, more repo trades. I think we had a lot of luck really in the back half of 2025 of getting clients engaged on collateral flexibility, collateral upgrade, downgrade trades, more so in 2025 than any year that I've been here. So I think the writing's on the wall to continue that trend, maybe earlier in the year. It's an accrual business, so the more we can get on the books early 2026 with some new clients, it should only bode well for kind of all involved. Not only is that, I think it makes sense from a market economics standpoint and kind of the way the market's going, I do think it helps the overall financing relationships as well. I do think the more of that we can do, I kind of mentioned, I think the more cash business that we can do, so we can keep our utilizations high as well, while also kind of getting trades that make some sense. So I think it's a good synergy business for all parties there. And we probably have, say, half a dozen clients doing that type of business now. I'd like to have a dozen to 15 guys this time next year. Optimistic, but I think it's a reality just with some of the conversations we're having and the way that looking at prospects and looking at estimates and things like that. It feels like it's being more and more thought of at earlier stages of the client's agent lender relationship. So I think that's definitely positive. I guess one thing I'm excited about next year, I think is going to be some opportunity for some trading opportunities. I think the Fed very much in play, interest rate volatility, I think it's going to be all over the place. I think the administration is going to get their wish with the more dovish Fed president next year. I think that's going to cause a lot of volatility. So it should open up some opportunities for us here.
Okay, good. All right. There was nothing that you want to do less of or that you aren't looking forward to, but I'm okay with that.
Yeah, I think I agree with
you're
you.
a glass half full guy, so I think
Jim
it's
kind of
consistent.
mentioned it too. I think more automation and maybe not say it in the way of less GC trading, because on my front, that's very hard. There's only a hand select special. I still need a job, but I do think the way to automate that and maybe do some more seamless trading via different platforms and other vendors is definitely something that we're engaging in.
Okay, good. Mark?
Yeah, it's like Jim and I work together or something, because what I'm going to say is going to echo what he hopes for. Yeah, so if someone asked me to describe 2025 in two major themes, it would be hard to borrows had a good year on IPOs, definitely led that, and then the balance sheet trade. So I almost want 2026 just to be more of 2025, but bigger and better.
Okay.
So we had the CoreWeave IPO. Now we have the SpaceX IPO likely coming in Q1. Jim pointed out a lot of our stock is indexed, but I think it's good for the market. And it looks like 2026 could have a really good IPO calendar. So I think those lockup trades will certainly be there. And then hard to borrows. We have Infosys today. It's a $76 billion company. And it's been one of the best trades of the second half of the year. So we're definitely seeing more tolerance for higher fees, and there seems to be more participation in some of these borrows. The crypto treasury companies were another good example. Then you had the quantum computing companies that all got added to major indices, traded from $2 to $30, for example. So there's a lot of these kind of names that are high beta, and there definitely seems to be good lending opportunities in those names. So I want to see more of those. I think we're going to get them, not just hard to borrow. I should say special situation trading in general. So we had Paramount, obviously, and we had a couple other events too, but we're already looking at Medtronic in the face for next year. So we have a couple events coming between the SpaceX IPO, the Medtronic spinoff that we know are going to be very good for the industry and will be profitable trades. So I think we should see more of those. And then Jim said the balance sheet trades, it's always evolving. So it's important to have a fluid mindset and to kind of quickly communicate opportunities to clients and work closely with borrowers. But even if there's balance sheet relief, then that's an opportunity, right? Every balance sheet trade doesn't have to be to help someone else play defense, right? If they can grow sheet or if they have a new axe to grind, then we want to be there. And I think what the eSec team has done a better job at is having better conversations with borrowers about the bespoke needs that they have in the funding space. Different regions are going to have different needs than different banks within those regions. And we're not splitting the atom. GC lending can only get so complex, but it's important to, I think, hear counterparties and not just say, hey, this is what I offer. It's this desk rate, and that's it. If I have to have 15 slightly different structures for 15 different counterparties that all look the same from 10,000 feet, but then do have some nuances, then let's do that. And I want to do more of that, and we're going to be able to do more of that because we're going to be more automated, to Jim's point. It's really hard to manage those trades off the desk. But we do have the opportunity to kind of tweak things at the margin and plug certain clients into certain borrowers or certain collateral types or tri-party versus bilateral, just things like that. All the nuances on the spectrum of GC trading, automation is going to help us be better partners for our borrowers in the GC lending space. And I'm really excited about that because sometimes people come to you with a wish list, like, hey, I can do these two because it's just really hard to support these other 3, 4, 5. And we're going to be able to support more of that wish list in an automated fashion and really allow more scalability in the GC space.
More of 2025, just bigger and better. Sounds perfect. And
yeah, you want to supersize it. It's like Jim's water cup.
That's right. I think that's probably base case. We're just looking at our book, and we think January is going to be a continuation of December, which was a very strong finish for us from both a balance and revenue standpoint. So I think
All
we're going to
right.
start the year off.
So keep on keeping on.
Yep, bigger and better.
All right.
Securities lending, just bigger and better. That should be our new slogan. What's our slogan? It's something like that, right? Securities lending.
Only better, bigger.
Only.
It should be only bigger and better.
There you go. We're
Or
going to change
only
that.
better and bigger.
We're going to
All
change
right. Am I allowed to share our Spotify Wrapped information now?
Yes, let's do it.
Okay. So, just as a both reminder and a disclaimer, not all of our listeners listen on Spotify. So the Spotify Wrapped, which I do love, and I'm not a Spotify user myself. I'm an Apple Podcast user, and so I don't get this personally in my life. But anyway, they do a great job of summarizing for content creators such as eSec Lending Insights, the usage and the listening audience and how that's changed year over year. And so we got it, and I'll give you some of the highlights. So our top country in 2025, not really surprising, but was the US. We were up in the people that follow us, so that officially we're in their feed, everyone, we were up 31% year over year in new followers. Our total new audience growth, though, which I think is interesting. So it means that there's a lot of people not regularly following, but tuning in, perhaps either by choosing the episodes individually or finding it in other ways. But that was up by 450% year over year. So that's a big growth number. Our most listened to episode, the year prior, if you recall, Matt Chessum was in it, and Chessum's going to be back with us in the new year. He's going to be giving us all the stats on growth in 2025 and such. So there's more of him to come. But this year, it was our September quarter end podcast when we were talking about the upcoming quarter end. And it was, interestingly, the first one that we had video, which I don't know how to play that out. I don't know what to make of that. But it was played
Nobody
57
cares about
more
seeing us.
times than our average listen.
I love that you think people want to tune in and see us. They don't care. Nobody wants to see us.
Especially when you're sitting there eating the whole time. Whatever, you look like a squirrel.
They are little seeds, little pumpkin seeds.
All right. Okay. So how about this quiz for all of three of you? Name our top 5 countries.
U.S.
Canada, London.
Brooksy.
Yeah. Well, you know, UK.
Yeah. Okay. U.S., Canada. I need 2 more. Nope.
I would say either is it Hong Kong or China?
Nope.
Is it Middle East somewhere?
Nope.
Germany?
Nope. You can let me know if you want any hints or want me to just really reveal it. Ireland, number 4. And number 5, it's actually a hotbed of securities lending and securities financing activity.
Israel?
Sarcasm or...
No, it is a hotbed.
Was it Israel?
No.
Australia?
Nope. Last guess. Reveal it, Brooke. South Africa. There's a lot of activity in South Africa in this space. So yes, so our top 5 country, US, Canada, South Africa, Ireland, and the special country that is London.
Those the 5 stops for your podcast tour?
Right, exactly. Yeah. Do you think that anyone would come if we did this live and in person? Like some other popular ones? Probably not.
I wouldn't think so, no.
All right. For how many people do you think we're their number 1 show?
What makes it the number 1 show? The most frequently?
Yes, the most. So for them, it's the one they listen to the most.
A percentage of people or an actual number?
Nominal number. We'll count the people. So think about Jim's mother and yeah, exactly.
Who doesn't listen to other podcasts. So we're definitely my mom's number 1 podcast.
It has to be people that only listen to music besides their security.
Oh yeah, it has to be Spotify users.
Yeah. So maybe Spotify users only too. So maybe they get their other podcast somewhere else.
Okay, well, Mike Brooks was the closest. He said 12, and the number was 14. We're in the top 5 shows for 54 of our fans, and we're in the top 10 shows for 81 of our fans. So I don't know. It feels pretty good, right? I don't know.
How's that compared to last year? Do you know?
You're asking me to do extra homework, and I did not prepare for that. So yeah, I don't know.
We came prepared, Brooke. by
If
the
they
way.
didn't produce it, then I don't have the figures. Give me a sense of the top artists that are people listening via Spotify to our podcast, their number one artist.
Wow, that's interesting. Billy Joel.
No,
I guess that's a no.
no.
I was thinking New
I do
York.
love a good Piano Man, but no.
Yeah, like
Yeah,
yeah, I like that.
that was stereotyping every one of your friends in New York, by the way.
How else are we
Is
going
it
to do
is
this?
it is it Swifties?
Woohoo! I was going to
Oh,
say it's Taylor
goodness.
Swift. Come on, just that's the
Yeah.
easiest. All right, and then this is hilarious. And there is a person that I'm going to call out. I don't know if she listens enough, but I know she does listen. But there's a woman, Eileen Hurley from JP Morgan, who told me once that other than listening to our podcast in the car, she's otherwise listening to audiobooks for her kids. And the top audiobook, probably because of Eileen, was Fantastic Mr. Fox. So
You talk about a small sample set. That's
Yeah.
what this is, where one person can skew
right.
our.
She may also Taylor Swift may also be her number one artist.
Right, exactly. And yours, most likely. So,
Yeah, probably. It's definitely mine. I'm
yeah.
currently watching her docuseries, which is also amazing, and it's making me relive my Eras tour moments. It's amazing. But
How about
anyway,
this? I wonder how many
yes.
podcasts had Taylor Swift as their top artist.
Oh, that would be interesting.
Like,
Yeah,
is it
I
a
bet a
third of all
lot, right?
podcasts?
Yeah.
Half of all
Yeah.
podcasts?
And how
Yeah.
many had Billy Joel? I'm just
The
curious.
other half?
Jim Maroney. Jim Maroney and his handful of stock loan friends. All right, friends. Well, anyway, it was a pretty successful year for eSec Lending Insights. I like to self-declare, and really looking forward to an even bigger and better year in 2026.
Bigger and better.
Yeah.
Happy New Year, guys.
Oh yeah, Happy
Yeah,
New
Happy
Year.
New Year.
Yeah.
Happy New Year.
All right. Is that it?
That's all I got. That's a wrap.
That's a wrap.
It's a wrap.
Nailed it.
What do we call? Yeah, nailed it.
Nailed it. Okay.
Thanks,
All
listeners.
right. Thanks, listeners. Happy
Thank
New
you.
Year. Thanks for listening. And now for our disclaimer.
This material is for your private information and does not constitute legal, tax, or investment advice. There is no representation or warranty as to the current accuracy of, nor liability for, decisions based on such information.